Hi, crude oil trader here. I did have one update that I wanted to show you guys. I used to use this for the S&P market, and I thought I'd take a look at it for crude trading, primarily because the type of market we're in right now, it being a range bound market. And today, as I discussed earlier, I took a short trade that ended up going back up pretty significantly over 60 ticks. So just looking at different strategies, I'm sticking with my plan, but I just remembered this strategy from the S&P market. I wanted to run it by you guys because it is quite interesting. So what you do is it's based off, this says S&P, but you can use it on any VIX market, any volatility index. And for those of you that don't know, the volatility, the VIX, basically it's a measure of the volatility in that particular market. So as I was saying to you, the volatility in crude right now is very low. This only goes back 3 months, but you can see that it's down around 25 right now, and it was up to like 34. So basically what this is saying is, in a intraday basis, which is how I'm trading, if the VIX is 34, you're going to have a wider range throughout the day. And with my type of trading, you want to have a wider range. If you like to fade the market, meaning take a counter trend trade, you could use this VIX to calculate where you would take a counter trend trade. So, for example, today the VIX is 24.89. I just want to show you the VIX on the S&P market just to give you a longer term view. So this is the S&P VIX, 13.5 right now, which is extremely low. And I want to give you a history of, well, maybe not that much of a history. I mean, this goes all the way back to 1990, but let's just see if we can get, yeah, okay. So this is the banking crisis here of 2008. You can see that this actually spiked up to over 90. It's not showing here because it was an intraday spike and then it closed, but the VIX was up to 80. And if you look back at those charts at the S&P, you'll see that there's those days, the ranges are unbelievable. Some of the days had 100 handle moves on the S&P, one direction to another, and we had that one day with 1,000-point Dow range. So, and then the VIX came back down, but more typical levels at 40 area. But you can see over the last couple of years, it's been pretty dead. For all of last year, the most the VIX went was 25. So it's been a very calm market, relatively speaking, to the past. So back to the oil VIX, what I wanted to show you is how to calculate your intraday range. And I guess you could use this with any value in the VIX. It might be useful for lower VIX values because if you're going to be trading a range type of market, you might be more beneficial. Because once the momentum kicks in, you can trade the momentum, which I find is a better way to go. But anyway, so here's how it goes. You open up the calculator. It's very simple. What you do is you convert the annual VIX percentage to a single day percentage. So you take the square root of the number of trading days in a year, 252, and you divide that by half. So that gets you to 15.9. So the way to remember is 15.9, and then you take your VIX, which here is 20, let's just call it 24.92, divided by 15.9. So that represents a 1.56% move in the crude oil market. So they're saying it's about 189 in their example, but this would be the expected average daily percentage change over the next 30 days. So what you do with this number is you take the price of crude, which let's put it at 94. So you take 94 times 0.0156. That gives you a daily range. So you're just converting the percentages. That's your daily range on crude. So if you want a range trade, what you're going to do now is you're going to take your 94.22, which is your high, minus your 1.46. So if you were going to take a range trade, you would want to start looking around 92.76 to get in. Now, today it didn't get to 92.76, but it did get the 92.96. So it was within 20 ticks of that move. So I don't know how many contracts you trade with, but if you wanted to start a contract a little early, you can tell that this would have worked out really well today. Could have caught 50 ticks in or around that if you started a little early, because it didn't quite get down there. But it's just a useful tool to take a look at on these types of days where you don't have any panic selling. It's just you get the sell off and then it just dries up and goes back up again. This is something that is interesting. I used to use it for the S&P market. Don't use it too much for crude because crude can move so much, but maybe I'll start looking at this when the VIX is slow, because you can really limit your risk. If you get in around this area, you can define your risk 25 ticks or so, and if it doesn't reverse, then you're out. But just thought of it, wanted to share it with you guys. Any comments you want to post on it, feel free. I just thought that it's interesting in this market because we are really dry on the momentum, and it seems every time there's a sell-off, it is bought up. So it would be a way to calculate where you should buy. Volatility is based off of the standard deviations of where the market should go based on where the VIX is. So it's actually, there's a lot of math involved in those numbers. So you're not just picking an arbitrary like support and resistance area, for example, on the chart. You're playing more a statistics type of play on it at that point. So it's all for now. Just thought I'd share that with you guys. Any comments, let me know.